what does the investment thesis look like at Runa Capital?
Well, it's very simple. And we believe that the good startup depends on three things, and that's good founders, and good founders. The key difference between Series A and pre-Series A is the product market fit. There are two risks basically that we take on after Series A. One is execution, and the other is how scalable is the business model.
Hey everyone, this is Prashant and I'll be your host of the VC 10X podcast, and today we have Dmitry Chikhachev with us. Dmitry is a managing partner at Runa Capital, a Series A focused VC firm with over $500 million in assets under management and 100 plus investments across 13 countries. In this episode, we talk about how Series A investing is different from pre-seed and seed investing, how VC is actually a hit-driven business, shifting Runa Capital headquarters to Europe, investing across 13 different countries, exciting portfolio companies, and a lot more. So without wasting any time, let's dive straight in. Hey Dimitri, so good to have you on the VC 10X podcast. How are you doing?
All good, Prashant. Good to see you too.
Yeah, pleasure hosting you. So to get things started, can we have your story and how you started Runa Capital?
Yeah, well, we've been around for 12 years. So the story started back in 2010, actually end of 2009, when my classmate, Serge Bell, called me and said, why don't we start a venture capital firm? I was doing something different at that time. I was a CEO of a startup myself for 3 years. That's manufacturing and operating vending machines. Not super techy, but anyways, I had startup experience, and I exited, and I was waiting for like a new gig, and that's when this call from my classmate came in. And frankly, my first question was, "What's venture capital?" I was in a real brick and mortar business at that time, and Serge told me, "Why should I tell you? I mean, buy a ticket to San Francisco, and I will introduce you to some people who know what it is." And then, long story short, I like mid-November 2009, I was in Palo Alto, and I met a couple dozen people from VC industry, business angels, and VCs, and startup founders, and by Christmas I had it. And then after that, actually, I went to Israel to meet some people over there. And long story short, by Christmas I had a clear plan how we run our fund.
Sounds pretty incredible. And how did you go about raising your first fund? How was that experience like?
Oh, that was not easy. As most, first-time managers, we had to go through, our family and friends, and our business connections. And what was very helpful is that my partners, my co-founder Serge, he was in software business since 2000, and he built already several quite significant software companies: Acronis, Parallels, Acumatica. So that was our track record, and basically our pitch was that if we could build those companies by ourselves, we could help others to build the companies. Our initial idea and still our kind of concept is that we not just provide money, not just provide capital to the founders, but also help them building the business.
Absolutely. Yeah, that's a great value add for founders to have someone who has already been through that journey to help you how to do that. And you've seen a lot of game film that how things play out in the startup world and how do you tackle different kind of problems. So it's great to have an investor who has the experience of a founder before. And talking about the evolution of the fund, so the first fund was what I've learned was about $135 million, and now you've about recently raised a 250 million fund four. So that has been quite an evolution over like likely the past decade of the fund. So how would you talk about this evolution, and how has the approach of the fund evolved over time during this entire period?
Well, frankly, I don't think we changed a lot our strategy over years, because this size of the fund is more like adjustment for inflation, because the round Series A rounds grew bigger. They basically twice as big as they used to be back in 2010. So that's why we need a bigger fund just to follow the same strategy. Otherwise, our main focus remains the same. We kind of, Series A is our bread and butter. We do a little bit of pre-Series A when the founders already have a prototype and we can kind of develop our conviction about product market fit, not from the traction, not from the market traction, but from our own experience with the product prototype and feedback from early customers. So we keep doing more or less the same. We added one more to be completely kind of precise. We added one more theme to our investment themes, and that's the quantum. So we initially started with software and deep tech software, enterprise software, and then quantum appeared in 2015 as a new kind of deep tech niche, and we being a physicist by training, we realized this is something very, very interesting and very, very high potential.
Yeah, absolutely. And talking about themes and the areas you invest in, what does the investment thesis look like at Runa Capital?
Well, it's very simple. We believe that the good startup depends on three things, and that's good founders, and good founders. And it's partly a joke, but partly true. Other than the founders, we of course pay attention to the product and technology, how good is and it is, how hard to replicate, how well built, and finally we pay attention to the business model and anything related to that, such as the market size, the competition, the unit economics. But basically, yes, three pillars: the founders, the product, and the business model. But the founders is obviously the most important pillar.
Yes, absolutely. And talking about Series A, I've hosted a lot of fund managers who are investing at maybe the pre-seed or seed level, but not a lot of them are investing at the Series A level, because most of them want to come in super early in the journey so they can get better terms in terms of how much equity they get. So I want to understand why you're coming in mostly at Series A, and how is Series A investing different from investing at seed and pre-seed, because at that stage, at that early stage, there is not a lot of proof, not a lot of data to look at. But at Series A, I believe you can have a lot more conviction with a lot more data. So can you explain that, like how does Series A investing differ from pre-seed and seed investing?
No, I think the key difference, well, at least in my understanding, the key difference between Series A and pre-Series A is the product market fit. Basically, Series A means that there is sufficient traction to prove the product market fit, and the founders, the team, needs to focus on execution, right? And pre-Series A, and I would say again, pre-Series A, in my understanding, this is something close to Series A. But let's say seed investments, that's when and pre-seed especially, that's when the product market fit is just a hypothesis, which needs to be proven, which means that the startup founders need to experiment a lot and they need to find the product market fit, right? And that's probably the biggest risk that the investors take, not the execution, but actually the product market fit, right? And we picked Series A for ourselves because we believe that we are more instrumental in helping founders to execute rather than in experimenting with early stage prototypes and which is requires a lot of coaching, a lot of day-to-day kind of interaction. For Series A, we need to spend more high-quality hours helping with the building the engineering teams, helping build the sales teams, helping to build partnerships and hiring senior management, senior talent for the company. So we believe that with our experience, our track record of entrepreneurs, we are more instrumental in helping startups at this stage.
Yeah, absolutely. So what I've built a hypothesis around is that you go for a Series A when your product market fit is already there and your numbers are already growing, and now you're looking to like rapid scale from there on, like no more experimentation, right?
Right. So yeah, there are two risks basically that we take on after Series A. One is execution, and the other is how scalable is the business model. Because sometimes there is product market fit, so we can easily kind of get initial traction, but it's not necessarily a profitable traction. It's not necessarily profitable at scale, right? and that's where we need to help the companies, and that requires deep understanding of business, the pricing, the customer acquisition, that all aspects, how you build your sales team in the efficient manner. So there are a lot of details that drive the economics of the business.
Yeah, absolutely. And one more thing I would like to ask you is, like the pre-seed and seed investors usually say that we invest at this early stage because we want to have that additional upside, that okay, if the company goes big from here, we are gaining a lot in terms of multiple x's of returns on the amount of investment we made. But in comparison, like series A, you are already kind of de-risk the investment because the company has already made some growth, has somewhat a product market fit. So do you believe that theory that the earlier you go in the life cycle of a company, the better it is for an investor? Or do you think that going in at series A is probably a better approach because it's the investment is already
Mm,
de-risked and you're now investing to scale the business forward?
mm. I think the VC business is like hit driven business. So it's not about how big share you acquire, and it's mostly about how many home runs you get in your portfolio, right? So it's back not to the valuation of the company, but it's actually back to how good are you in identifying those stars that will deliver the result of the fund, right? And again, if obviously the hit rate at super early stage is much lower than at Series A. So the like standard numbers for Series A are like 30, 10, right? So 30% write-off, 30% money back, 30% moderate return, and 10% home runs. And for seed and pre-seed, these numbers are much lower. I think the write-offs for seed are 60% at least, and so people are taking bigger risks, obviously, and the question is how many hits they have in this portfolio, and then how well are they protecting their initial share from dilution. So each stage of investments has its own business model with its own drivers, which include the risk, hit rates, valuations, time between the investment and the exit. So I can explain in detail how Series A functions for seed and pre-seed specifically. I think models are more intuitive. They're less kind of less financially based, less scientific. And there are different models, I think, for early stage investments. Um, so hope this explains
Yeah,
a bit the how we feel about it.
right. Right, it does put things into perspective when it comes to pre-seed, seed, and investing at the Series A stage. And talking about the sectors that you invest in, so you've talked about it before that you're mostly investing in deep tech technologies and then now quantum as well. So why have you picked this particular sector? Because you previously worked maybe in a hard tech kind of a space yourself. So why have you picked at Runa Capital that this is the sector that we want to go after, and this is the sector we are going to see the
Yeah,
returns?
well, the simple reason. I mean, one reason is that we are by training we are engineers, physicists, computer science by initial training. I have second degree in business, but again, this initial training helps to understand the tech, right? And then my partners, my co-founders' business, the companies Parallels and Acronis, they're both enterprise software deep tech companies. So we had access to many talented engineers, which obviously helping us in diligence and in management of portfolio companies. So, and we believe that would be our advantage. Most VCs are not, at least 10 years back. Now it's changing, but 10 years back, most VCs were not very techy. Most of them had financial background.
Yeah.
So we thought that the fact we understand the technology, so we are founders ourselves, and we understand the technology, that kind of gives us a certain edge.
Yeah, certainly that makes sense. And recently, we just talked about the sectors that you're investing in. let's now shift our focus to the regions you mostly focus on. And recently, you've made kind of a big move in in that area, wherein you have shifted your headquarters from the United States to now in Luxembourg, which is in Europe, right? So, why have you made this switch? Can you give us some perspective on these two different markets and why the shift of the headquarters to another continent?
No, I think this is a good question, and this is of course has a symbolic meaning, more than like a real shift, right? Because we still have our team in Palo Alto, and it's a big team, and we continue investing in the US and in North America. We are not kind of scaling down our US operations, but we want to give a strong signal to Europe that we are European investors. I believe that Europe evolved significantly over the past 10 years. We did our own research, and let's say 10 years back, the difference in terms of capital deployed, like early stage VC capital deployed, the difference was 6 times between the US and Europe. Nowadays, it's only 2 times. So Europe is catching up rapidly. And we see more and more US funds landing on European soil and kind of making their presence visible to local startups. So, and we being here for many years, we wanted to kind of emphasize that, yes, we are also a European investor and we are looking for European startups. I believe that Europe is a great source of talent, comparable to the US. I think the biggest problem for European startups was the fragmentation of the market, because the market, EU is European Union is still different countries. You have cultural differences. You have certain, you have languages, and that of course is not does not make it easy for a startup to scale their businesses. But I think Europe is overcoming that, and we see more and more kind of talented teams who are giving traction on global scale. So we want to give strong signal to Europe that we're here.
Yeah, that's amazing. And I recently came across a study that said that European VCs are actually producing better returns on the amount invested than the United States VCs. So that's an interesting insight.
That's a questionable observation, because again, our own research showed that the returns are equal. So we saw that the difference is in terms of how much capital is deployed, but not in terms of how well this capital performs.
Okay, so amazing. So basically, it may be the case of what's the target area that we are doing the research on. So maybe it's that. But yeah, sure. More or less, they're like, one conclusion we can definitely derive is that definitely these two markets are maybe coming to par with each other, and that's a good sign, right?
Absolutely.
Amazing. So you have investments across 13 different countries around the world, right? So I want to ask you that how do you keep up with trends across all these countries and see the amazing founders that are coming up in all these countries, and what are the trends? And like, every country has their own different regulations, a different startup ecosystem, like different markets. So while you're evaluating these investment pitches from different countries, how are you taking all these geographical things in concern, that is this a good investment to make or not? Because then when you're investing in a different country, a lot of other factors also come into play, because you're probably not familiar with that outside market in terms of geography, but it seems like a good investment. So how do you make that investment?
That's a good question. First, I need to comment that when we invest in different countries, that doesn't mean we invest in different markets. We invest in the talent that is sourced in those countries. But the market for most startups is still global, right? So we discussed earlier that VC is a hit-driven business, and to become a unicorn, you need to be successful on the global market, not just in one country, right? So from this perspective, we don't need to pay attention what are local regulations, what are local, let's say, barriers for the businesses. I think the only thing that matters is perhaps what is local labor cost, and what is local quality of talent, right? What is local availability of talent. But even for talent, many startups are using now currently cross-border employment, and they're using a lot of remote workforce. So even here we see that the borders are disappearing. So this is first comment. The second comment is that actually in tech, I think the startups and young people, the founders, they have more in common than differences, because they all got same training in computer science. They all speak English. English for venture capital, it's like Latin for medicine, so it's like it's a must, and so those people have a lot in common. And after we started investing in different countries, we realized that there is no huge difference, right? Of course, you need to pay attention to local cultural differences when you evaluate the founders team. And for this reason, we always prefer to have a local co-investor. Like when we invest in France, we normally have a local French co-investors, local French fund. Same in Germany, same in other countries, because again, people from the same country, they can better understand the founders, better understand their kind of culture.
Yeah, absolutely. And talking about the language that you just talked about, that in Europe, I believe like there are some countries which don't have English as their first language, but they have their own native languages that they speak predominantly, and you don't expect that most people would know English, right? They don't have a dominant English population. So in those cases, do you take that into account, that okay, this is not an English speaking country, or a founder who is not very fluent with English? Does that come into account when you're making the investment?
That's what I was trying to say, that most young people from tech industry, they all speak fluent English, because this is a new generation. And even if English is not commonly, first, English is quite commonly spoken in most European countries, right? But even in countries when English is not kind of super well spoken, the younger people, the people from, especially with people from tech, with tech background, they speak good English, because this is very important. If they plan building a global company, I mean, you start from mastering the global language. Otherwise, how you talk to your customers, how you talk to your partners. So that never been a problem.
Yeah, that certainly makes sense. And now talking about, you've invested in a good handful of companies, right? So would you like to mention a few of your portfolio companies that are doing amazing work right now?
I think, yeah, I would probably mention a few. One company is Mambo. That's a fintech infrastructure. So this is a German company, originally, German founders, but with development R&D in Romania, which makes it less expensive. And I think that's a very good move from one founder's side to kind of minimize their R&D cost at early stage. So the company is getting amazing traction, and they were valued. We invested in Series A. The valuation was still low teens, and now in the last round, the company was valued at 5 billion by pre-IPO investors, CPT. They will likely go public in the next few years, and that would be an amazing result for Fund One. And then one of our latest investments, which also a good illustration of the quantum team, is a company called Pascal. This is a French team from Paris-Saclay University, near Paris. They're building quantum computer based on super ultra cold atoms technology, and they're, I think, one of the leading teams globally in this space. One of the co-founders of the company was recently awarded Nobel Prize in Physics. His name is Alain Aspect. So now I can say that we not only have unicorns in our portfolio, but we also have the companies where the founders awarded Nobel Prize. So ask other VCs, do they have many companies like that? So probably that's a very special case. So that's probably give you some flavor of what kind of companies we invest in.
Absolutely, and that also goes on to add more force to your saying that we actually invest in founders. So that was a pretty incredible founder that he has actually won a Nobel Prize. So that is the amount of focus that you put in on the founders. Brilliant. So now talking about your due diligence, because recently we have had some cases in the industry wherein due diligence all of a sudden has become a lot in focus, like everyone is talking about it.
Mm-hmm.
So how are you conducting due diligence on the companies that you are investing in?
Well, first of all, it needs to be diligent. Sorry for being tautologic, but this is we need to be diligent. We need to pay attention to details, right? So so this is rule number one. Rule number two is that we should not rely too much on our own judgment, but we should try to get third parties' opinion. Like we always try to involve experts, like people who are experts in the industry, people who are experts in the market, in the country, to provide their opinions. So because the unbiased opinion is always very, very valuable. We of course we ask the customers, the early customers about the product. We ask the partners about how they work with the team. We check the background of the founders, the track record, and so again, it's a lot of details. But all this diligence is about three things. It's about the founders, how competent they are, how committed they are, how complementary is the team, and how good is the relationship in the team. So it's on the founders side, and we try to find evidence to prove that, right? The second part is around the product. So it's probably the easiest part. I mean, we just need to find people who are experts in this technology. So to look into that, into details, to see the code, the actual code, how it's written. Is it a good code, high quality, or it's a spaghetti code? And that gives us a lot of information, obviously. And then finally, the business model side, we use Excel as many others. So we try to evaluate and use our gut feeling and use the benchmarks to estimate how realistic is the business model and how realistic are assumptions behind the business model. So it's a lot of work. I mean, it's a teamwork. So it's a few our own team members participate, but we'll also pull many external experts.
Great. That sounds great. And since you've been in this VC space for quite some time now, it's been over 100 years now. Oh, sorry, 10 years now. 10 years now. So how do you look at this industry right now, and what change do you want to see in the VC ecosystem?
What change I see? Well, I think it's getting more international. Well, that's clearly true for Europe, but also for the US, because let's say 10 years back, the US VCs were mostly focused on the US market and US startups. The European VCs were very much focused on their home countries. And then in 2012, we made our statement that we want to be, pan-European and transatlantic VC. And I think now many kind of firms, they have the same vision. They want to be global VCs, right? Because again, going back to the thesis that this is a hit-driven business, you look for global champions, right? And the global champions could come from any country, not necessarily the US or France or Germany. They could come from Finland or Romania or any country. Like, so to be really successful in finding those future global champions, you need to look everywhere. And we see that a lot of new hubs are emerging, right? So the gap between the US and Europe is bridging. We see new hubs in Europe, like Barcelona and Madrid in Spain, and southern Sweden. They kind of becoming more and more noticeable. And same for the startups. They don't focus on raising money from their local VCs. They travel abroad. They travel to London. They travel to Palo Alto to raise capital, even at early stage. We see like companies like Y Combinator, they recruit globally, right? So I think that's the trend, and basically that's I like this trend. Hope this continues, because that's really kind of global economy.
Absolutely, yeah. Bringing the world together now. That's the mission, and that's what we are seeing in action right now already. All right. So now moving on to our closing round, which is a rapid fire round. So I'll ask you 5 quick questions about the fund at Runa Capital, uh, and about where you invest and the check size, etc. So if you're good for it, we can give it a go.
Sure, let's go.
All right. So the first one is, what are the sectors and regions you invest in?
We invest in North America and Western Europe, and the sectors include software, deep tech software, B2B software, fintech infrastructure software, as well as quantum technologies.
Great. What's the typical stage of investment for you?
Typical stage is Series A, even though we sometimes do pre-Series A, which means just one step before.
Got it. And what's the typical check size?
The typical check size could be between 2 million for pre-Series A and 5-6 million for Series A as initial investment, and we can scale this check up to 10-15 million for the most successful companies over lifetime in subsequent rounds.
Right. And where can founders pitch you?
Well, they can pitch us in any of the physical locations we have, but as well they can pitch us on Zoom. We are physically present in Palo Alto, London, Berlin. I'm in Luxembourg, but I spend quite a lot of time in Paris. But we are always happy to have an online pitch and meet in Zoom before we travel to meet each other.
Yeah, sounds great. And the last one is where can our listeners follow you?
So we are most active on LinkedIn, I guess, and we put some stuff on Medium from time to time. But I think if you follow our LinkedIn page, you would get most up to date on where we are and what we do.
Yep. Got it. Got it. I'll make sure to put all those links in the show notes below. Thank you so much for coming on, Dmitry. It was a pleasure hosting you, and happy investing.
Yeah, thank you for hosting me. It was a nice chatting. Thank you so much for great questions.
Pleasure is all mine.
Thank you, Prashant.